Today, I'm showing you the 2026 Second Wind Playbook and how you can secure the top 5% of assets in the country. I'm Roy, and if you haven't yet, hit that subscribe button right now. This is the most important 10 minutes you'll watch this year. The biggest mistake I see investors making right now is looking at national house prices. In 2026, there is no such thing as a national market. We are in a K-shaped recovery. On one end, you have the premium high quartile suburbs in Sydney and Melbourne that are slowing down because they have hit an affordability ceiling. On the other end, you have the second wind markets like Perth, Brisbane, and regional service centers where demand is still accelerating despite the rate hikes. The smart money is currently rotating out of low yield, maintenance heavy passengers and into supply constrained heroes. National listings are down 12%, and in cities like Perth, there are 50% below historical averages. That's a shocking supply that's coming on the market. When the supply is this tight, the interest rate becomes a secondary factor. We're not saying it's not important, but it becomes a secondary factor. You aren't just looking for a bargain, you are looking for access. Access to stock that simply doesn't exist to the general public. This is the first rule that you have to pay attention to. This is the first rule of the second wind markets. Follow the supply gap, not the media headlines. Rule number 2, vibes are out and predictive data is in. In 2026, the competitive advantage has shifted to those who can read market signals before they become price reality. AI these days lets us identify micro markets, individual streets, or pockets with strong local employment multipliers. We're looking for towns where one major infrastructure project like the $515 million Darwin ship lift or the $30 billion suburban rail loop creates a ripple effect of auxiliary jobs. This is how we find the next Perth. We track real-time internal migration flows, which are currently 17% above historical levels for regional hubs. If you're still waiting for a property to hit a listing portal like realestate.com, you've already lost. Second wind belongs to the data-first investor who secures assets off market based on predictive growth signals. Finally, let's talk about the structure of your wealth. In this cycle, yield is somewhat like your fortress. It's no longer just a nice to have. With interest rates rising, you need to stay on top of your portfolio. Create a hybrid portfolio. For example, target properties that combine high yield with strong capital growth. Unlike properties like units in Sydney and Melbourne, we can look at co-living properties, dual key properties, or duplexes in markets like Brisbane, Tassie, Perth, and so forth. Funny enough, you can look into energy efficient and EV ready homes. In 2026, properties without solar or a charger are viewed somewhat at a disadvantage to a lot of tenants. They're viewed as dated properties. By future-proofing the infrastructure of your assets today, you're ensuring that you remain in a blue-chip suburb with a blue-chip renter for years to come. 2026 is going to be a year that rewards knowledge over luck. Whether you're leveraging your SMSF to buy in Perth or navigating the APRA debt-to-income limits, the path to outperformance runs through data, better partners, and smarter execution. That's it for today. Make sure you are subscribed to the channel, hit the bell icon for our weekly updates, and I will see you in the market. I'm Roy. Thanks for watching.